Most people think the stock market is a high-stakes gambling den filled with confusing charts and shouting traders. But what if I told you it's actually just a giant digital marketplace, no different from a grocery store or an app store where you can buy pieces of the world's most successful businesses? Today, we're stripping away the jargon. By the end of this video, you'll understand exactly how the market works, how money is made, and why you don't need a finance degree to get started. Imagine your favorite local pizza shop wants to expand to 10 new locations. They need money to do that. Instead of taking a massive loan from a bank, they decide to go public. They divide the ownership of the business into millions of tiny pieces. These pieces are shares, also known as stocks. When you buy a share of a company like Apple or Nike, you aren't just betting on a ticker symbol. You are becoming a partial owner of that business. If Apple sells more iPhones and their profit grows, your piece of the company becomes more valuable. However, the opposite is also true. If the company struggles or loses its edge, the value of your piece may drop. All this buying and selling happens on exchanges, like the New York Stock Exchange or the NASDAQ. Think of an exchange as the operating system for the market. It's a digital platform where buyers and sellers meet. The price you see flickering on your screen is driven by one thing: supply and demand. If a company releases a revolutionary new product, more people want to buy the stock than sell it. This high demand drives the price up. If a company faces a scandal or poor sales, more people want to get out than get in. This high supply drives the price down. The current price is simply the last price, where a buyer and a seller shook hands digitally and agreed on a trade. You've likely seen statues of a bull and a bear. These represent the mood or sentiment of the market. A bull market describes a period when the economy is great, jobs are plentiful, and stock prices are charging upward. Investors feel bullish. They are optimistic. A bear market is the opposite. It's a period where prices fall by 20% or more from recent highs. Investors feel bearish, they are cautious, fearful, and tend to retreat. Understanding these cycles is key because markets don't go up in a straight line. They breathe in and out. When you're ready to buy, you'll use a brokerage app. You have two main ways to buy. First is a market order. This is the Buy It Now button. You get the stock immediately at the current best available price. Second is a limit order. This is for the patient investor. You set a specific price, say $100. Your order will only execute if the stock hits that $100 mark. If it stays higher, you don't buy anything. Inside the order book, you'll see the bid and the ask. The bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller will accept. The gap between them is the spread. In popular stocks, this spread is usually just a penny, meaning the market is highly liquid and easy to enter or exit. There are two main ways to build wealth in the market. The first is capital gains. This is the classic buy low, sell high strategy. If you buy a stock at $50 and sell it at $70, that $20 profit is your capital gain. The second way is through dividends. Some established companies, like Coca-Cola or McDonald's, don't need to reinvest all of their profit into growth. Instead, they send a portion of it back to you in cash. For long-term investors, dividends are like getting a thank you check just for holding the stock. How do we know if a company is truly big? We look at market capitalization. This is calculated by multiplying the current stock price by the total number of shares outstanding. Companies are grouped into small cap, mid cap, and large cap categories based on this value. Large cap companies are usually stable blue chip stocks, while small cap companies are younger and riskier, but have more room to grow. Instead of watching 5,000 individual stocks, most investors watch indexes like the S&P 500. This index tracks the 500 largest companies in the US. When news anchors say, the market is up today, they usually mean an index like the S&P 500 is performing well. Before you dive in, you need to understand a few risks. There is a strategy called short selling, where an investor tries to profit when a stock falls in price. They borrow shares to sell them now, hoping to buy them back cheaper later. This is very risky because if the price rises, the potential losses can be huge. You should also know about beta. Beta measures how jumpy or volatile a stock is. If a stock has a beta of 1.5, it moves 50% more than the general market. It's a wilder ride. To judge if a stock is a good deal, many use the price to earnings, or PE ratio. It compares a company's price to its actual earnings. A high PE might mean people expect massive growth, while a low PE might mean the stock is undervalued. If picking individual stocks feels too risky, you can buy a mutual fund or an ETF, which stands for Exchange Traded Fund. An ETF is like a basket that holds hundreds of different stocks at once. If one company in the basket fails, the other 99 protect you. This is called diversification, and it's the closest thing to a free lunch in the world of investing. You might also look at dividend yield, which shows how much income a stock provides relative to its price, helping you compare different income-generating investments. The biggest mistake beginners make is confusing trading with investing. Trading is like sprinting. It's about short-term price jumps and requires constant attention. Investing is a marathon. It's about owning great businesses for years or decades to let the power of compound interest work its magic. The stock market is a tool for building long-term wealth. Don't feel like you need to master it all today. Start small, stay curious, and keep learning as you go. The more familiar these concepts become, the more confident you'll feel in your financial future. If this breakdown made the market feel a little less intimidating, hit that like button and subscribe. In our next video, we're going to show you exactly how to research your first stock, step by step. You won't want to miss it. Share this with a friend who's ready to start their financial journey. Thanks for watching.